Something is breaking right now, and it's not just one thing. Gold is sitting above $4,000 an ounce, silver is holding near $59, the Japanese yen just crashed to a 40-year low before an emergency billion-dollar intervention yanked it back. The Supreme Court struck down tariffs. Then, within hours, new tariffs replaced them under a different legal path, and the 30-year U.S. Treasury bond just hit its highest yield since 2007. One headline you can explain away. Two headlines may be a coincidence. But when gold, silver, the yen, tariffs, and treasury bonds all break in the same week, that is not noise. That is the financial system sending you a signal, loudly, in every language it knows. And yet, most people watching financial news this week are walking away thinking these are 5 separate stories. They are not. They are one story. And by the end of this video, you will be able to read it. I'm OG Asian Guy, and we do not just read headlines here. We read what's underneath them. Before we go any further, if this kind of deep breakdown is what you've been looking for, hit that subscribe button right now. Most channels give you the headline. We give you the full picture. And here's what I want to know from you. Of everything happening right now, gold, silver, the yen collapse, or the tariff chaos, which one worries you the most personally? Drop it in the comments. I read every single one, and the answer you give shapes the next video I make for this community. Now, let's get into it, because every minute of this is going to matter. Part 1. Gold. The scoreboard is already on. Let's start with gold, because gold is the clearest scoreboard the market gives us. As of right now, gold is trading just above $4,000 an ounce. That number sounds dramatic, and it should. Just 12 months ago, analysts were still debating whether gold could ever clear $3,000. It didn't just clear it, it tore through it, briefly touched $5,597 in January of this year, and has since settled into a consolidation zone near $4,100. That is not a commodity doing what commodities do. That is a global trust referendum, and the verdict is not going in paper money's favor. Here is what most people miss when they look at the gold price. They ask, why is gold going up? The better question, the question that actually tells you something useful, is, what has to be breaking for gold to go up this fast? Because here is the uncomfortable truth about gold. Gold does not rise in a healthy world. Gold rises when the people and institutions responsible for managing the financial system, central banks, treasuries, pension funds, sovereign wealth funds, quietly start to wonder whether the rules they built the system on are going to hold. And right now, they are wondering, loudly, with their wallets. Central bank gold buying has been running at record levels for multiple consecutive years. And critically, that buying did not slow when prices moved above 4,000. It re-accelerated. You don't buy more of something at a record price unless you believe the current price is still cheap compared to what's coming. The 52-week range for gold sits between $3,300 on the low end and $5,597 on the high end. Gold has already traveled nearly $2,700 in price in 12 months. That is not a rally. That is a repricing. And reacting to it now is not early, it is not late either. But understanding why it's happening is no longer optional. Part 2. Silver, the louder signal most people missed. Now let's talk about silver, because silver's story this year is actually more extreme than gold's, and far fewer people have been paying attention to it. On January 29th of this year, silver hit an all-time nominal high of $121.67 per troy ounce. That happened. That is a verified number. And it happened in a matter of months after silver was sitting around $40 just last September. That is a move of roughly 200% in under 5 months. Since then, silver has pulled back significantly, and today it is trading near $59 an ounce, which, and this is the part that tends to snap people to attention, is still nearly 50% above where it sat a year ago. So why did silver move that fast? And why should the pullback from $121 not be read as the story being over? Silver is a dual-engine asset. It has a monetary engine and an industrial engine running simultaneously, and right now, both engines are being pushed hard. The industrial engine. Silver is irreplaceable in solar panel manufacturing, in electric vehicles, in semiconductors, and in medical equipment. The world is consuming more silver than it mines for the 6th consecutive year running. That is not a forecasting model. That is a documented physical supply deficit that has been building for 6 years straight. Above-ground inventories are materially thinner than they were 5 years ago, and that buffer is not coming back quickly. The monetary engine. When investors lose confidence in paper currency, when central banks are printing, when debt is spiraling, when bond markets are stressed, money moves into real, tangible assets that governments cannot manufacture on a printer. That is exactly the environment we are in right now, and silver, as the more accessible and more volatile sibling of gold, tends to move faster and harder in both directions when that monetary demand kicks in. The gold-to-silver ratio today sits at roughly 69 to 1. That means it currently takes about 69 ounces of silver to buy 1 ounce of gold. Historically, at the peak of major silver bull markets, that ratio compresses dramatically to 30 to 1, sometimes even 14 to 1. When it compressed to 32 to 1 in April of 2011, silver had already risen more than 12-fold from its earlier lows. When it fell to 14 to 1 in January of 1980, silver had completed a 39-fold bull run from roughly $1.50 to $50 per ounce. A 69 to 1 ratio, with silver still below $60 after pulling back from over 120, does not look like an ending. It looks like a mid-cycle reset. And here is the rehook I want you to sit with for the rest of this video. Everything we just described about silver, the supply deficit, the industrial demand, the monetary demand, the ratio compression, every single one of those factors is being amplified right now by the three forces we haven't even talked about yet: the yen, the tariffs, and the bond market. Keep watching, because this is where the full picture comes together. Part 3. The yen. What happens when a government fights its own currency? The Japanese yen breaking to a 40-year low is not a Japan story. I need to say that plainly, because the way most financial media covers this makes it sound like a regional issue happening somewhere distant. It is not. Japan and the United States are financially interlocked at the deepest level. Their bond markets, their banking systems, and their currency arrangements are all connected. When Japan shakes, the tremors travel directly into American markets, American mortgage rates, and American grocery prices, whether anyone in the room wants to acknowledge that or not. Here is what actually happened. After weeks of warnings, the yen broke through 163 to the dollar last week, a 40-year low, driven partly by Middle East tensions sending investors to safe haven dollar assets, and partly by the persistent wide gap between US and Japanese interest rates that makes holding dollars structurally more attractive than holding yen. Japan's Ministry of Finance, almost certainly in coordination with US Treasury authorities, then launched an emergency intervention. According to Bank of Japan data released this week, Japan spent approximately $58 to $73 billion in foreign reserves in a single week to buy yen and drag the currency back from the edge. The yen spiked from 162 to 157 yen against the dollar in roughly 1 hour. Markets noticed, traders noticed, and what they took note of was not the rescue. It was the fact that a rescue that size was needed in the first place. Now think about what that intervention required. Japan had to liquidate tens of billions in reserves to defend its own currency. But the yen is still trading around 157 to 160, nowhere near where Japanese businesses, importers, and everyday consumers need it. The emergency measure bought time. It did not fix the underlying cause. The underlying cause is a rate gap. The U.S. Federal Reserve is holding its benchmark rate at 3.5% to 3.75%. The Bank of Japan just kept its policy rate at 1%, its highest level since 1995, with only one dissenting board member pushing for an increase to 1.25%. That gap, roughly 2.5 percentage points between the world's two largest economies, is why global capital keeps flowing toward dollar-denominated assets and away from yen-denominated ones. The Bank of Japan Governor Kazuo Ueda said it plainly this week. If we fail in our pursuit of stable price growth, we could be forced to raise rates rapidly, and that would cause nominal rates to rise significantly and destabilize markets. Read that statement carefully. The head of Japan's central bank is saying out loud that the alternative to small rate increases now is a disruptive, destabilizing move later. That is not reassurance. That is a central banker describing a trap they are trying not to trigger. And here is what this means for gold and silver specifically. When a major reserve currency economy is forced to spend the equivalent of a mid-sized country's annual GDP defending its currency in a single week, and the currency is still sitting at a 40-year low, that tells global investors one thing clearly. Paper money, even from sophisticated economies with advanced central banks, is not unbreakable. And every time that message gets delivered at this scale, A portion of global capital looks for something that cannot be printed, cannot be devalued by a committee decision, and cannot be dissolved in a political emergency. That something is gold. That something is silver. Part 4. The Fed, the bond market, and the crack in the foundation. Last Tuesday, the Federal Reserve held its benchmark interest rate steady for the 5th consecutive meeting. The rate sits at 3.5 to 3.75%. Now, maybe in a normal environment, a Fed hold is not news. Central banks pause all the time. The story moves on. But this was not a normal hold. This hold came with a 9-3 split. 3 Federal Reserve officials publicly dissenting, arguing that waiting any longer risks forcing far more aggressive action down the road. 3 dissenting votes at the Federal Reserve is not a footnote. It is a fracture. It tells you there is no consensus inside the institution tasked with managing the most important interest rate on the planet. And the bond market heard that fracture clearly. Within hours of the decision, the 30-year U.S. Treasury bond yield surged to its highest level since July 2007. It crossed 5.2%. Let me translate what that number means for real people. The United States is currently carrying national debt that generates roughly $1.08 trillion in annual interest expense, approximately $2.96 billion per day. That is more than the entire annual defense budget flowing out the door in interest payments alone. And that figure is based on the current weighted average interest rate of 3.41% across all Treasury debt. As older, lower-rate bonds mature and get refinanced at today's rates that are meaningfully higher, that annual interest expense climbs further, not in a decade, starting now. The 30-year yield at 5.2% is not just an abstract market signal. It is the borrowing cost the U.S. government pays when it needs to raise long-term money. And at the same time, the Congressional Budget Office is projecting a fiscal year 2026 deficit of roughly $1.9 trillion. The cost of servicing existing debt is moving higher because of market forces nobody in Washington controls. Fed Chairman Kevin Warsh acknowledged the rise in Treasury yields in his press conference. He said the committee will not hesitate to act if inflation pressures accelerate. But markets are already interpreting the split, the rising yields, and the inflation data still running well above target as signals that September's meeting is live, with roughly 60 to 68% probability of a rate hike already being priced in. Here is the mechanism that connects this directly to gold and silver. When a government is running a nearly $2 trillion annual deficit, paying over $1 trillion in interest alone, facing a bond market demanding 5% for long-term lending, and holding rates steady while inflation sits at 3.5%, the only historically documented exit from that combination of pressures is to eventually inflate through the problem, to allow the currency to do some of the work that fiscal discipline is not doing. Every major economy that has faced this exact pressure profile has eventually inflated. And every time an economy inflated to reduce the real burden of its debt, the price of real assets, measured in that currency, moved higher. Not because gold and silver are fashionable, because they are the exit door. This is not prediction. This is a pattern that has repeated across centuries and across continents. And the numbers surrounding the U.S. right now, the deficit, the debt cost, the bond market, the split Fed, the yield spike, form a pattern that serious analysts have seen before. Part 5. Tariffs, the political trigger running underneath all of it. Now let's put the final piece in place, because without understanding tariffs, the full picture is incomplete. On February 20th of this year, the Supreme Court ruled 6-3 that the International Emergency Economic Powers Act, the law used to impose sweeping tariffs, does not authorize the president to impose tariffs. In a landmark decision, the court said that authority belongs to Congress. Within hours, the administration signed an executive order imposing a 10% global tariff under Section 122 of the Trade Act, a rarely used provision allowing duties up to 15% for 150 days. That provision expired on July 24th. Now, a new wave of tariffs has been filed under Section 301, the same authority that previously enabled trade actions against China, applying to an estimated $949 billion of annual imports. And within the same week, legal challenges from small businesses have already been filed in the Court of International Trade in New York, arguing these duties are also being applied without proper legal grounding. On July 28th, President Trump said publicly about the new tariffs, "It's a shame that I have to go a harder way for the tariffs because the Supreme Court, in a very close decision, ruled against me." That single quote tells you everything you need to know about the state of U.S. trade policy right now. The president wants the tariffs. Courts keep ruling against specific legal mechanisms. New mechanisms get found. New lawsuits follow. And in the middle of that legal back and forth, businesses that import goods, manufacturers that plan supply chains, and countries that export to the United States cannot make stable long-term decisions. Japan was separately hit with 25% tariffs on its exports to the US. That pressure, combined with the rate differential we already discussed, is a direct driver of yen weakness. When Japan's exporters face a 25% cost increase at the American border, the natural pressure valve is a weaker yen, because a cheaper currency partially offsets the tariff cost on the buyer's side. So the tariff and the yen collapse are not two separate stories. One is feeding the other. And here is the mechanism that connects tariffs back to gold and silver, to the bond market, and to everything we've covered today. Tariffs raise import costs. Raised import costs show up in consumer prices. Rising consumer prices make inflation harder to kill. Sticky inflation makes the Fed's job harder, forcing either higher rates, which stress the bond market and raise debt costs, or patience, which allows inflation to run and erodes confidence in the dollar. Either path has costs. Either path pushes the same money toward the same destination, assets that don't sit on anyone's balance sheet, assets that no court can rule against, assets that no executive order can redefine, physical gold, physical silver. That is the mechanism. That is the full picture. Conclusion: the signal is already there. Let me bring this full circle. Gold above 4,000 is not a speculative bubble. It is a global trust referendum where the vote is being cast in real money by central banks, sovereign funds, and institutional investors who have been building positions quietly for years. Silver at $59, after briefly touching 121, is not a story that's finished. It is a story in the middle of its second chapter, being written by an industrial supply deficit that's been running for 6 years, and monetary demand that is just beginning to pick up serious institutional attention. The yen at a 40-year low, requiring $70+ billion in emergency defense, is not a Japan problem. It is a demonstration of how much stress the global currency system is carrying right now, and of how quickly that stress can become visible when conditions shift. Tariffs being struck down, rebuilt, challenged, and rebuilt again are not just policy noise. They are sustained inflationary pressure being injected into an economy where inflation is already above target and the bond market is already demanding 5% yields for long-term lending. And the Fed's split decision, 3 dissenting votes, 30-year yields at a 19-year high, a September rate hike priced at 60-something%, is a signal that the people responsible for monetary policy do not have a clear, unified exit path from the corner they are in. These are not 5 separate headlines. They are one system under real, documented, measurable pressure. And the scoreboard, $4,000 gold, $59 silver, a 40-year low yen, a tariff system in legal chaos, and Treasury yields at 19-year highs, is telling you plainly what is happening underneath the surface. I'm not here to tell you what to do with your money. That is not what this channel does. What this channel does is make sure you are never the last person in the room to understand what the room is actually talking about. And right now, the room is talking about one thing clearly. Every currency on Earth is under simultaneous stress. The question is whether you are reading the same signal they are. If this broke it down in a way that finally connected all the dots for you, leave a comment below. Tell me which piece of this surprised you the most. Was it the yen intervention cost, the 30-year yield number, the tariff legal cycle, or something else entirely? Subscribe to OG Asian Guy if you want this level of breakdown, not once in a while, but consistently, every time something important moves. And share this with one person who's been asking why everything suddenly costs more. They deserve the full answer. I'll see you in the next one.